the stock market has pulled back quite a bit recently. It's off about 5% from recent highs. Not quite in correction territory, but it's about halfway there. Um, and I already thought a lot of stocks in the dividend space, especially in real estate, were kind of cheap going, even at the highs, because they were still pretty cheap compared to where they used to trade, mostly on interest rate headwinds. So there are some good buying opportunities right now. Before we dive into my favorite stock on my watch list right now that I don't already own, take a minute and check out the link you see on your screen, fool.com/Frankel. You get a message from my sponsor, the Motley Fool. You can get the top 10 stocks to buy right now. It's a great way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So the number one stock on my watch list that I don't own right now is a company that I used to consider one of the more boring real estate stocks in the market, and that is Prologis, ticker symbol PLD. If you're not familiar, Prologis is an industrial REIT. They own large scale warehouse and distribution properties all over the world. If you've ever seen one of those giant Amazon distribution centers, it's the size of like 5 football fields. There's a solid chance that Prologis is the company that actually owns that real estate. Amazon is one of their top tenants. They also lease properties to other companies that need a lot of distribution space, like FedEx, UPS are both among their top 10 tenants. Home Depot is a big tenant. In all, they have 6,700 customers, but all the large e-commerce players are among them. They are the largest REIT or real estate investment trust in the world. They have an enterprise value of over $200 billion when you just look at the properties they own. And there's a few reasons I really like them right now. So, for one thing, the recent boom in e-commerce, and I'd say recent meaning since the COVID pandemic started, there's been a lot of growth in e-commerce. A lot of it was pulled forward, but at the same time, there is a lot of long-tailed growth potential in e-commerce, so a lot of it is here to stay. Just for context, about 15% of U.S. retail sales are currently e-commerce based. That percentage is even lower in most other markets around the world. So, and it's been steadily up, ticking upward for about 2 decades now. So there's a lot more room for e-commerce in general to grow. E-commerce needs a lot of fulfillment space as opposed to brick and mortar retail stores. More people are buying things online and having them shipped to their house. In the meantime, that has to go somewhere. That's why UPS and FedEx are big tenants. So that created a lot of demand over the past few years and a lot of rent growth, which we'll get to in just a second. But just looking at Prologis, they have a fortress balance sheet. They have a debt to capitalization ratio of about 20%, meaning that if you look at the total value of the business, only about 20% of it is made up of debt. This would be like if you bought a house and put 80% down and took out a mortgage for 20% of the property. It's a nice margin of safety to have. They are just getting into the data center space, so they see opportunities there. They're committing $25 billion to building out data center properties, which I think is a great way to kind of invigorate growth, because if you think even the e-commerce market is mature for the time being, or that the distribution market is mature for the time being, data centers are still very much in demand right now. So I like that move. Diversifies the income stream a little bit. The current state of Prologis, their occupancy looks great. That's right around 97%. It has declined a little bit. We'll get to that in just a second. And in the first quarter, they reported 96.8% occupancy. Management said that interest rates are weighing on lease absorption and things like that in a lot of key markets, and that the next quarter or two will be slower than expected. Another reason that I think this is a great opportunity that caused the stock to drop. But 96.8% occupancy and a 74% customer retention rate when leases expire is pretty impressive in a challenging economic climate. Prologis grows through both acquisitions and development. They're doing a whole lot of both. And one of the key parts of my investment thesis here is the embedded rent growth. I mentioned that the boom in e-commerce really led rent growth to surge. Well, a lot of Prologis's leases are 5 years, 7 years, even longer in length. And a lot of its tenants are still paying pre-pandemic prices. So as those leases expire, they're being reset either through a renewal or by finding a new tenant to a much higher rate. And how much higher is kind of remarkable. In the first quarter, Prologis reported a 48.2% in cash rent growth throughout its portfolio. That's on both new and renewal leases combined. So when a lease expires and a new tenant starts paying rent to Prologis, they're paying 48% more than the previous lease called for. That is a remarkable amount of money, amount of growth, and there's still a lot of that embedded in the company's current leases. The company said the mark to market spread of its leases, meaning the difference between the market rent and what they're actually receiving from a tenant, is about 57% as of the end of 2023. So a lot of room for rent to grow. There's a great opportunity right now. As I mentioned, the stock declined significantly after its most recent earnings, which were just reported, because the CEO says that the next quarter or two is going to be slower than expected. Interest rates are weighing on the environment, as are geopolitical concerns. And the company lowered its guidance for occupancy, same store net operating income growth, and funds from operation, which is the real estate version of earnings. So not great news, but temporary not great news. The stock is down 19% from its recent highs as I'm recording this. It has a 3.4% dividend yield, and its valuation is deceptively low, or I'm sorry, deceptively high due to that embedded rent growth. It trades at a multiple of about 20 times funds from operations, but remember that its average property is worth 57% more rent than they're getting right now. And as leases expire over time, that will gradually be worked in. So even without any other growth factors being, happening in the business, you're talking about an 8% plus rental growth rate for the foreseeable future. So really good opportunity to buy Prologis while it's significantly down. One of my favorite stocks in all of the real estate space right now, and I think it's a lot more exciting than it used to be, especially with that embedded rent growth. Great balance sheet. I mentioned the data center space is a big promising growth area for them. And if you look at all the largest REITs, say American Tower, Crown Castle, Equinix is one of them, Digital Realty Trust. If you look at all the top REITs, none of them have the combination of growth opportunity, safety, embedded rent growth potential, and valuation as Prologis does. It's just a very good all-around stock to buy right now, and it's one that I plan to add to my portfolio very shortly. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.